Africa investments, which is part of the FSD Africa group. We are funded by the UK government, and our role is to support the development of the financial markets in Africa. We intervene with grants and technical assistance, providing advice to governments, policy bodies, as well as intermediaries in the market, such as stock exchanges. But we also invest, and we invest in financial firms and funds that we think are pioneering and can help transform financial markets in Africa to benefit access of capital to business, as well as better services for households. One of the investments that we made was in the Africa Local Currency Bond Facility, which perhaps you're familiar with, whose purpose is really to try to unlock local savings through local bond issues, whereby the Africa Local Currency Bond Fund supports listing of bonds and guarantees the uptake of bond issues. We were looking at what could potentially be a way to stimulate more IPOs on Africa's stock markets. And so in that context, FSD Africa decided to gain a better understanding of what really is the market failure. So why aren't companies in Africa listing on our stock markets? And is there something that we at FSD Africa Investments could do in order to stimulate that? So to answer those questions, we commissioned a study which was undertaken by RisCura, by Gerald Gondo and his team. Gerald is a business development executive at RisCura. And so we're very excited to share with you this morning the findings. So Gerald will present the findings to us, and we have an excellent panel of discussants coming from the cross universe of IPOs. So Mary Njunguna is with us here at FSD Africa and is a senior manager in our capital markets team. We have Catherine Swanepoel, who's with South Suez Fund of Funds. We have Ibukun Adebayo, who's with the London Stock Exchange. Carol Atabora, who's with Hudson & C, as well as Cyril Yode, who's with Hudson & C. So without further ado, I am going to hand over to Gerald, who will give us highlights of the findings, and then he'll moderate the discussion with our distinguished panel. And again, I just want to thank you all for joining us today, and especially our panelists for giving us their time and insights on this important topic. Gerald, handing over to you.
Unmute. Thank you, Anne-Marie, and morning to all of you. A special thanks to those who are in the Northern Hemisphere. It is an early start, so we do appreciate it. I'm just going to call up the presentation now. Cool. Hope everyone can see that. And just before I start, some housekeeping. The webinar is being recorded, and we are also going to take in your questions via the question and answer box. So that little box at the bottom of your screen. So don't press the raise your hand, so no one will answer you. You can type in your questions. And thank you again, Anne-Marie, for introducing our esteemed panelists. And yeah, we'll get started in terms of really sharing what we felt was I think a perception changing study, at least when we started it at the back end of 2019. Our thoughts were that we were going to survey various market participants in different countries by traveling to each of these countries and really getting an on-the-ground experience of why are there bottlenecks or why aren't IPOs happening, and made our travel plans to travel in the first quarter of 2020. And COVID thought differently, and we ended up multiple Zoom calls and invited really into multiple homes across the continent. So we really do thank all of the market participants, the regulators, and market players for enabling us to undertake the study, which we hope will really add to the evidence-based and data-based research that is being championed by FSD Africa, really to try and deepen African financial markets and strengthen financial markets. So this really just covers how we went about the study. It ended up being all of 118 pages, I think it is. So we've truncated that into an 18-deck slide. But I think what the first key takeaway that would really want people to appreciate, which may sound tongue-in-cheek or said before, but really the fact that it was really a wide-ranging study covering multiple African countries. And for us, as researchers, the key takeaway was really that as you spoke to each of the market participants, the regulators appreciated some of the nuances within each of these markets. One needs to appreciate that the development of African capital markets and the deepening of African capital markets is transitional. It's certainly not an intervention that can be undertaken as if it's arriving at a destination. The nuances that are relevant in Zambia are very different to the nuances in Tanzania, which are very different to the nuances that are being grappled with in Cote d'Ivoire. So certainly a one-size-fits-all in terms of understanding why aren't IPOs happening at the rate that all of us would like them to happen in each of these countries cannot be addressed by a one-size-fits-all approach. It really does require a very intimate understanding of the bottlenecks that are particular to each country, and then developing a solution from the ground up. So now turning to, well, what is the actual IPO experience? And the survey was over a 5-year period, 2014 to 2019. I think the key takeaway for us is that we were actually surprised at the quantum of capital that has been raised over this time, over this 5-year period. $2.3 billion is not a small chunk of change, and more importantly, it was raised across most of the key markets that we expected the capital to be raised, and unsurprisingly, Nigeria took the lion's share of capital raised via IPO across our survey countries. What kind of reinforced what we all knew, and suppose kind of plays into the narrative around capital raising in Africa, is that the quantum that has been raised has really been concentrated across financial services and telcos. And that's certainly one of the aspects that we'll tap on Catherine and the other panelists to say, well, why is that the case? We are aware that in most African countries, 70% of our GDP is agriculture. Why is it our economies are not translating into our capital markets? And that is one of the questions that we grappled with within the survey that I think regrettably, there was not one answer. What was very apparent was really the fact that the agricultural sector, whilst a big employer and a big component of gross domestic product generation in a number of our African countries, is also the sector that has the most or the greatest prevalence of micro SMEs. So disparate people all acting in concert to create this 70% of GDP on average for most African countries. But those type of enterprises are not necessarily translating into capital market operators. What was also quite surprising is that, initially we thought, okay, $2.3 billion, a lot of money, but then we looked at it on a per country basis across time. And I suppose that's where the disappointment came in and reinforced, the IPO narrative really is not playing out in Africa, and that if you take out 2014 and if you take out 2019, the average value that has been raised across our survey countries is actually slightly over $100 million on average over a 5-year period. Now, and that's a travesty in terms of our capital markets working. Intuitively, the biggest economy on the continent raised the most amount of capital. But again, if you then take out the listing of Airtel, Nigeria as a country has not really fared very well in terms of being able to raise capital, despite being now the largest economy on the continent. And again, the question is why? And we kind of did a quick back of the matchbox calculation and said, taking away Airtel, how much did Nigeria raise on average over that 2015, over that 5-year period? And it was slightly over $200 million. Now, biggest economy on the continent, on average $200 million per annum. And look at BRVM, which is the youngest stock exchange conglomeration on the continent. And it's punching way above its weight, $400 million on average over the 5-year period. So there's definitely speaks to the narrative of, where are these bottlenecks taking place on the continent, and why is economic growth not translating into capital market development. Similarly, so for BRVM, if you take away the listing of the Aura Group, which is a large financial services business, it drops to zero, right? So not only is it lumpy across time, and not only is it also concentrated on these specific industries of telcos and financial services, but removing those industries from that narrative, it certainly translates into a poor diversity in terms of translating economic development into capital market development, as well as the fact that either the capital market operators are not targeting other industries within our economies that can be candidates for IPO listing on our stock exchanges. So we then said, okay, fine, maybe this is just a problem with our survey countries. Let's look a bit broader. And so we went to North Africa and I suppose bifurcated our study to say, what's happening in North Africa or outside of our survey countries? And is it common to what we're seeing in our survey countries? And the answer is quite stark. If you look at other or North African countries, the diversity that you see within the economies is also translating into the diversity within their capital markets. And if you're looking only at the lens of capital being raised, it's also translating into capital being raised across greater diversity across their industry sectors. So certainly a key takeaway for us is that what are the learnings that we should be then taking from the Egyptian capital market authorities, or the Moroccan stock exchange, or the Tunisian securities regulatory authority, that can be shared with sub-Saharan Africa and East African and West African counterparts? How is it that they are managing to ensure that the diversity that they're seeing in the economies is also now translating into their capital markets? South Africa, during the survey period, was a bit of an anomaly in that the listing of one financial services business, essentially carving out of a segment of Old Mutual, their wealth management arm, and the dual listing of that entity on both the Johannesburg Stock Exchange as well as the London Stock Exchange kind of distorted the figures. But if you then take out South Africa and only look at the North African countries, Egypt, Morocco, and Tunisia, it says two things to us. Number one, the ability for you to translate GDP diversity into capital market diversity is supportive of capital market development. But more importantly, number two, the quantum of the capital that you're raising is a lot greater because you're bringing in more businesses across more diverse sectors of the economy onto your capital market. So, I mean, the average of Egypt, Morocco, and Tunisia is nearly 2.5 times bigger than our survey countries. They, on average, you're raising upwards of $250 million within these specific countries. So now really turning to our survey countries and sharing with you some of our insights. But before we get into that, I'll ask Mary to, Angela, to switch to our first poll, and I'll take a quick glass of water whilst we take our poll. Wow. So the cost of listing on and ongoing cost of remaining listed on these African stock exchanges, is that really a key deterrent of new IPOs happening? And the jury is quite skewed. We've got, 15 seconds left for people to vote. And it's certainly skewed towards 75% or plus 70% of the attendees anyway are saying yes. It is too expensive, and the costs are a limiting factor for new IPOs happening on our continent. Okay, so 69-31. So if there are regulators or executives on African stock exchanges and Ipo, I'm sure you will have quite a bit to say in terms of the interactions that you've been having with African stock exchanges and regulators from your position on the London Stock Exchange. This is a key area that needs to be addressed in terms of, I suppose, one, are the costs of listing and ongoing listing on our African stock exchanges valid? I mean, you can't list for free, but are the costs commensurate? Two, are the costs commensurate with the capital being raised? And I suppose three, the third area of doing so is to say, if our intention is to get more small and medium-sized enterprises listed on our stock exchanges, is the market structure and the composition and the cost base of our stock exchanges commensurate with these key participants that we are targeting? So I'll move on. In terms of the East African insights and highlights, what was certainly key for us, which was, I suppose, intuitive, is really the strong family-owned entrepreneurial base that is prevalent within the East African region. But more importantly, what was unbeknown to us is really the perception of many East African entrepreneurs of how bank funding and private equity funding actually are competitors to the option to list. So for many East African entrepreneurs, their contention is that if my family-owned business that I've been running for the past 20, 30, 40, 50 years, I'm now on my second or third generation, I'm open to the fact that I do need third-party capital to either grow regionally or fulfill my expansion plans for this family-owned business. But I've got options. I actually don't need to only look to the Nairobi Stock Exchange or the Rwanda Stock Exchange or Dar es Salaam Stock Exchange to unlock that capital or for me to actualize my growth plans. There's strong presence of private equity for which I can turn to. And similarly so, banks are a lot more alert to the need for them to be providing a lot more flexible financing within East Africa now. So listing is a distant third option for many of the conversations that we had with private-owned businesses or family-owned businesses in East Africa. Similarly so, what was their aversion to not only third-party capital, but listing? The strong sense of, well, the decision-making is going to move away from the family table. And not only is it now going to move away from the family table, with private equity, we can still keep the decision-making private. We're not so comfortable of opening up, our decision-making to the public. And then secondly, it's really the contention of remaining a minority investor of part of a very large business versus control. And again, the value proposition of saying, well, by listing, you have the ability to tap a much greater capital market, but you will still remain a significant shareholder, and your wealth will grow through that. So I suppose the narrative of democratizing wealth doesn't necessarily resonate with a lot of the family-owned businesses in East Africa, because for them, control actually is a very important aspect in their determination. So the concept of IPO needs to grapple with those type of realities, particularly in East Africa. The second aspect, which we've known and have banged our heads on the table and continue to engage with all market participants, is really the fact that institutional investors in East Africa remain skewed to investing in fixed income, right? And you kind of try and corroborate the growth that you're seeing in terms of, for example, pension funds in East Africa. 10 years ago, it was less than $2 billion. Now, Kenya's institutional asset base is nearly $12 to $13 billion. But that quantum of growth, where has it gone? It's effectively gone into buying more government bonds. It's not being translated into the real economy. So the question is really to say, for institutional investors, with the dichotomy that you're facing, whether you're looking at the Nairobi Stock Exchange or the Dar es Salaam Stock Exchange, where for all intent and purpose, you are investing in 5 counters on the Nairobi Stock Exchange. Safaricom being 60% of what you're investing in, and then you can add Equity Bank and a few other banks and the beverage companies. How are you expecting the market structure to change if you're always investing 80% of your capital in fixed income? Similarly, so the market structure is not going to change if you're not supporting new equity issuances. So on the one hand, when speaking to the regulators, they are bending over backwards in terms of cutting the cost of listing, relaxing the requirements for those emerging or growth companies within each of these jurisdictions, developing incubation plans to allow for companies that could list to be comfortable with operating within the public space. But despite all those efforts, ultimately, when the tire hits the road, you do need institutional capital to support you. But at the moment, institutional capital is largely being invested in fixed income securities. So the market structure and the market composition is unlikely to change with that background narrative still at play. So we then asked ourselves the questions, well, could it possibly be a regulatory problem? Maybe pension funds in East Africa aren't allowed to invest in IPOs. That's not true. So again, engagement with the regulator, the capital market authorities have shown that from a regulatory perspective and from a policy perspective, pension funds can invest in new security issuances on their stock exchanges. The key question remains, why is there this high proclivity to yield and an aversion to equity? And ultimately, some of the conversations that we had with the asset owners, ultimately the trustees, is that it's their time horizon. For many trustee bodies who are sitting as trustees, generally their terms are 3 to 4 years, and they can only sit for 2 terms. So within a 6-year period or an 8-year period, their primary interest is to make sure they maximize return. And at the moment, the security that gives them the best rate of return with least risk is a government bond, giving them double-digit yields. So within that 6 to 8 year period, there actually is no incentive or there actually is no imperative for the average body of trustees to look to invest in riskier securities. Why? Because they don't want to take risk whilst they are sitting trustees of pension funds. So in terms of market developments for East Africa, key takeaways, and again, Angela will provide the link to the broader study. certainly in terms of the architecture of these market structures, it does need to change. There needs to be greater collaboration between institutional asset owners and the efforts that are being made with the regulatory authorities. Similarly, so because of the thriving activity that's happening, private equity activity that's happening, greater synergies and conversations need to take place to incentivize private equity players to view the Nairobi Stock Exchange or Dar es Salaam Stock Exchange or Uganda Stock Exchange as exit opportunities. Right? But similarly, so what incentive are you giving to the private equity practitioners that is either equal or better than the trade buyers that they are facing? A conversation needs to also take place in terms of just being realistic in terms of the liquidity that we see on our African markets. And one private equity practitioner said, listen, there's no point me taking an unlisted company, listing it in the Nairobi Stock Exchange, and there's no assurance of liquidity taking place because all the liquidity is stuck in Safaricom, EABL, and other large accountants, right? Over and above that, there's also a requirement for me to be locked in for a specific period of time, right? I would much rather introduce immediate liquidity by going to a trade buyer. So their contention is that let's have realistic conversations in terms of the liquidity that we are seeing on our African markets. And then again, bringing in Ibo, what was a strong feedback from many of the participants is that within East Africa anyway, because of the tie-up that is between the Nairobi Stock Exchange and the London Stock Exchange, we do need to see greater harmonization and collaboration for initiatives that support the growth of SMEs. And the example that was used there is companies to inspire. Quickly touching on Southern Africa and not to reduce its importance, it's just that it was one country, Zambia. And sadly, the conversation is very short in Zambia. Crowding out. So again, you look at the exercise that we ran courtesy of the World Bank of, you know, if you are a commercial bank in Zambia, you receive a deposit, do you lend it to an SME or do you give it to the Bank of Zambia or the government of Zambia? And it's a quick option. You buy a government T-bill that's giving you plus 20%, don't take credit risk, you don't need to mark down that asset in terms of your Basel requirements or any regulatory requirements, versus lending to an SME where you have to provision, you have to monitor the credit, etc., etc. So in Zambia, the big macro stumbling block that one has to deal with is really this case of crowding out, the negative yield that you're then going to be getting by taking either equity risk or non-government risk. Similarly, so in Zambia, what was quite surprising to us is that the Lusaka Stock Exchange is viewed by many market participants as really a creation of the government and the World Bank. So as part of the privatization drive that the government of Zambia undertook, they identified specific state-owned enterprises, brought those onto the Lusaka Stock Exchange and said, right, we've got a stock exchange. But the market participants or the man on the street really did not have a role to play in the organic formation of the stock exchange in Zambia. So there actually is no culturally, there's no affinity to the Lusaka Stock Exchange. So we thought, okay, maybe that's just the man on the street. Let's go talk to some of the corporate leaders in Zambia. And for many of the CFOs that we spoke to, two aspects came to bear. On the one hand, again, there's no cultural understanding and cultural affinity to the Lusaka Stock Exchange and how it can help their capital raising or balance sheet initiatives in the first instance. And then secondly, for many of the market participants that we spoke to, was really the fact that for many of the companies that already are listed on the Lusaka Stock Exchange, they are often subsidiaries of multinational companies. So they never actually are going to use the Lusaka Stock Exchange, or even more broadly, the Zambian capital markets, to raise capital. If they need to build a new cement plant or a new a beer line or beverage line, they simply take the capital from their parent company and deploy that capital. So they actually are listed in name, but don't functionally use the Lusaka Stock Exchange for its core purpose in terms of capital raising. And then you can see sentiment from some of the market players, and that there's a perception that because the Lusaka Stock Exchange remains a mutual exchange, it's the preserve of the old boys club. So in terms of some of the recommendations that came specifically from Zambia, again, the website will give access to more broader recommendations, but really to change this perception of really the Lusaka Stock Exchange being used as a privatization dumping ground, for want of a better word, by the government. Similarly, so where privatization should be taking place, it should be taking place with those entities that have the best merits for privatization. And the contention there was, why list a forestry company when there's a better asset that's being held in by IDC Zambia? And then, you know, the last key takeaway is really a policy and regulatory question, to say the market perceives there being effectively two regulators of the Zambian capital market, and those two regulators are not harmonized. They don't speak to each other. The market feels that the fees levied by both regulators are also a deterrent to further capital market growth in Zambia. Oh, and one other point, there effectively are two main asset owners in Zambia: African Life, a subsidiary of Sanlam, and the government pension fund. So if you are a private operator looking to list on the Lusaka Stock Exchange, if those two don't underwrite you, you pretty much are, you know, not going to successfully list. Why? Because all the other institutional investors really take their lead, and if either one subscribes and the other doesn't, it's a negative sign. If neither of them subscribes, it's a double negative sign. And generally, if both of them subscribe, because of the size of the issuances in Zambia, generally both entities then take up a massive portion of whatever is going to be listed, and thus negating liquidity of the broader market. So I think for us, Zambia presented the greatest, or rather a unique case of multiple areas that need to be worked on in order for the capital market to function. Moving on to West Africa, we'll pause there for our second poll. I'll take another swig of my water. So given depressed valuations on African markets, do you expect to see more delistings in 2021? Okay, Angela, we'll give it 10 more seconds and we'll close it off. It looks like even Stevens, yeah? The attendees are in two minds. So less of a substantive vote here. The attendees are of the opinion, 56% say yes, they are expecting, because of depressed valuations, for more delistings. That may play well into Catherine's narrative, and 44% are saying no. So with West Africa, for us, the key experience that we felt was really the cultural differences that that are self-evident when moving from East and Southern Africa to West Africa. whereas in East or whereas in sub-Saharan Africa, you know, entrepreneurship still needs a lot of nurturing. In West Africa, it's vibrant. And we use the case in point here in Nigeria, where, you know, 41 million micro enterprises, so nearly 4 times the population of a country like Zimbabwe and Zambia, just in micro enterprises, right? Slightly less small businesses, 71,000, and medium enterprises, 1,793. So entrepreneurship is thriving in Zambia, in Nigeria, and more broadly in West Africa. If you're looking at the initiatives that the Nigerian Stock Exchange has undertaken, great strides in trying to put together the right market structure from the premium board to the main board to the growth board, in terms of inviting these enterprises to list. But the key thing culturally in Nigeria is that there's a proclivity that, you know, I don't want to formalize, and in Nigeria the informalization actually is the norm. So one needs to now deal with that cultural difference of saying, you know, if we are so many micro enterprises, what are the benefits of us now formalizing our businesses and now listing on the Nigerian Stock Exchange or on other stock exchanges in West Africa. Similarly, so in West Africa, very similar to East Africa, is the fact that your institutional investor base, again, has a proclivity to fixed income investments. More so in Nigeria, largest economy on the continent, fastest growing private pension plans on the continent as well. Because of the reform that took place in Nigeria, you now have a growth of just under $200 million a month in terms of pension fund inflows that are going into the Nigerian pension funds. But again, that's all going into fixed income. So again, the ability to now speak to institutional investors to migrate their asset allocation to equity, and for them to take greater risk away from government bonds in order to develop the equity capital markets. Key takeaways from both Ghana and Nigeria was really related to, in Ghana, the regulatory structure, where essentially the main pension fund, which is SNIT, if SNIT does not underwrite your issuance, there's also a risk of your issuance not being successful. And similarly, so within the current laws in Ghana, your inability for the average pension fund to participate in an IPO, which was amended on a once-off basis when MTN Ghana decided to list. So from a regulatory perspective, harmonizing those laws to support the growth of IPOs. And then the absence of underwriters, as I mentioned, in Ghana, being SNIT being the main one, but similarly so in Nigeria, again, related to the regulatory environment. In law, a pension fund administrator, so the pension fund managers, are viewed as one entity. So that limits their ability to now underwrite or participate in IPOs, because the regulator only views the fund as an entity, whereas the fund is representative of multiple contributors and multiple investors that'll participate in an IPO.
Time check.
So sorry about that. So yeah, just looking at the market development recommendations, key feedback that came from the some of the commercial lenders in Nigeria and Ghana particularly, was the fact that the precedent of NPLs being solved by creating these special purpose vehicles that effectively take off these bad loans off the banks and curate them away from the capital markets has set a bad precedent. whereas both the regulator and the banking environment should actually be looking to the capital markets, not only to resolve NPLs, but integrating capital markets in terms of the banking framework. And then similarly, so just the, again, from a regulatory perspective, the fact that you cannot list or you cannot IPO if you have not got 100% underwriting. Again, it's a limiting factor, particularly if you add to the fact that only one institution has the ability to underwrite 100%. Whereas if you share that load across other market participants, you have a greater likelihood of more IPOs taking place. So lastly, turning to Francophone Africa. Again, culture was a key inhibitor there. Entrepreneurs, they're very hesitant to open up their books and to use the capital market. Similarly, so if you're looking at the structure of the BRVM or even the BVMAC, it's a multitude of countries, a multitude of entrepreneurs across various countries that you are now asking to list on one of two exchanges. The level of education that now needs to take place across the broad section of those countries is great. Similarly, so bank funding remains a strong preference for many entrepreneurs in these in those jurisdictions, and the ability for an entrepreneur to have a very finite view or a clear view of, I go to the bank, I give them assets, there's a price for the funding, I pay it back over a specific period of time, and that's the cycle done. Whereas with an IPO or equity listing, it's not as finite. And again, it's a cultural and educational aspect that needs to be brought to the fore there. But for Francophone Africa, what was most startling for us was really the appreciation of the tax regime there. And we were walked through this process, courtesy of Hudson and C, who are the panelists, really to show us the disincentives that the various tax regulations across these multiple countries present as a limitation to IPOs. So if you're a corporate, there's capital gains tax and dividends tax that kind of amounts to 33%. Similarly, so if you're an individual and you buy a share, you're going to pay tax of 12.5%. But whether you're a corporate or an individual, if you buy a government bond, there's no tax. So again, there's a massive disincentive for participation on anything that is related to the equity market, both from an entrepreneurial perspective, but as well as from an investor perspective. So the harmonization of tax across those markets is a major requirement in terms of crowding in capital for IPOs. I think in closing, and I'm mindful of time, for us as the researchers, we're extremely appreciative of the fact that, you know, African stock exchanges really need to be approached, and the development of them needs to be approached, again, not as a one-size-fits-all, but really as a transitional process that's really going to involve multiple stakeholders in order for the growth of these capital markets to crowd in capital, and particularly crowd in retail capital within our African countries. With that, Angela, I hand over to you for the last poll, and then we'll open it up for a discussion with our panelists. So the question really being, are pension fund regulations too restrictive? And again, it looks like an outsized vote to yes. So definitely our attendees are of the view that pension fund regulations do need further reform to cultivate and support IPOs on the continent. I can only thank you all for listening to me. I am now very excited to open it up to our panelists. Anne-Marie has already introduced them. So without further ado, if perhaps I could start with Catherine in terms of perhaps just key takeaways from you in terms of some of the key findings from the study, but more importantly, giving some insights from your vantage point as one of the largest institutional investors within the private equity space in Africa, and the interaction really of private equity with capital markets, and looking specifically at IPOs.
Thanks, Gerald. Happy to do that. And I think I would just say I think this study was really interesting. And I think a lot of the themes here will probably be, if you just ask someone off the top of their head what they thought, some of the things they would pick out that you've mentioned. But it's great to have it all consolidated in one space. And I do agree that the markets in Africa, we all talk about Africa, but it's a big continent, and there are vast differences between different regions. So it's important to keep that in mind when we're generalizing. That said, I think there were a lot of really good points made here. And I think the last point, that you finally left off with about, stock markets or stock exchanges not being an island and needing to be seen in a general context is very important. And that's obviously also something that we need to just keep in mind. So, I mean, from a private equity perspective, all over globally in developed markets and even other emerging markets, the IPO or the stock markets play a pretty important role as a potential mechanism for exit for private equity funds. And that hasn't really been the case in Africa, as we've seen. It's pretty limited. So again, mostly the largest opportunity for exits or channel for exit in private equity in Africa has still mainly been trade buyers. And I think certainly private equity practitioners and funds would love to see more development on the local stock markets and a potential and the ability to IPO locally, because it would be a real addition to ability to exit for private equity funds. So we have seen some markets have made great strides. So I think you mentioned Egypt as one of those, and I think a couple of points that I just wanted to pick up on Egypt and your comparison between, say, North Africa and some of the other markets, I think was very interesting. And we do need to keep in mind that Egypt, has the advantage of being a pretty large market. So I think that, that is one advantage that unfortunately not all of the, the countries and stock markets in Africa have. But they did have, the market was not as active as it is now in, say, 2013 and 2014, just before this, this study, kind of the period that the study covers. We saw quite a lot of delistings actually in Egypt, because the pricing and the value that was ascribed to some of the businesses was just not there. But Egypt has undertaken obviously significant reforms, general economic reforms. And that's also gone hand in hand with reforms on the actual stock market as well. And I think that, one of the key aspects is the free float of the currency. That's obviously something that is given kind of impetus for private sector investors. The other reforms in the market have really attracted international private sector investors as well, both to private equity, but also to the stock market. And so we've seen a really big increase in foreign inflows on both those aspects. And it's a little bit of a virtuous circle, so you're seeing some of that foreign participation come back, the private equity practitioners, but also family owners or institutional owners of businesses are able to then see that they are getting more value for the businesses that they IPO, the businesses that they've IPO'd have traded well if they're in the right sector and the right business and they're a high quality business. And then that gives impetus to future private equity funds or holders of businesses to continue to look at IPO markets. And, it doesn't even take that many. It's a handful of really good businesses that IPO that trade well that starts to create this virtuous circle. And I think that's something that's pretty important. One thing I just did want to kind of comment on before I know I've spoken quite long, but I think the point around culture is very important. I think families in Egypt in particular and in North Africa, a lot of the ones that we've spoken to see listing as actually quite prestigious. So, you know, when they start to grow, they actually want to list their businesses because they see themselves as a CEO potentially or an equity holder of a listed business, which is quite prestigious in North Africa. And they see private equity as helping them along that path instead of being a competitor to a listing. You know, so they use private equity rather as somebody to help them professionalize their business before they go to the stock market or before they IPO. So maybe just stop there because I don't want to, you know, dominate the whole conversation.
We could go on forever. Thank you, Catherine. And I'd like to pick up on that notion of culture and possibly bring in both Cyril and Carol, where you've really been at the forefront of the establishment and burgeoning of the BRVM, but it hasn't been an easy road. Perhaps your experience in terms of, on the one hand, dealing with the cultural aspects of Francophone West Africa entrepreneurs and getting them to formalize and to appreciate the role of the capital markets. And then secondly, why are we not seeing more throughput from what seems to be a very lively entrepreneurial ground within your markets? Carol and Cyril?
Yeah. Morning, everybody. Okay, so we'll just do a teamwork here. Cyril is more comfortable in French, so we'll go in French, and I'll just do my best to translate for you guys, if it's okay.
Sure thing.
Okay, thank you. Alors, sur le marché, effectivement, nous avons de nombreux entrepreneurs qui sont d'ailleurs, on va dire, à succès, qui remplissent un certain nombre de critères pour pouvoir être listés à la bourse, mais malheureusement, comme vous avez fait le constat, il n'y en a pas beaucoup, ce n'est pas un succès. Alors, cela s'explique d'abord d'un point de vue culturel, on a un blocage, c'est-à-dire qu'il y a une méconnaissance déjà de ce que le marché peut apporter à ses investisseurs, ça c'est le premier point. Le second point, c'est, on va dire, une sorte de peur, la peur de perdre le contrôle de l'entreprise. Et ça, c'est vraiment un gros frein. Donc, il y a un gros travail d'accompagnement à faire. Ça peut durer plusieurs années. Et à la fin, quand l'entreprise, effectivement, a un business plan qui est robuste, lorsqu'il y a un besoin particulier, il peut commencer à regarder et faire le pas.
You're correct in saying that you know, in our market there are a lot of entrepreneurs indeed, but the reason why we don't see it translating into you know, IPOs and you know, into our capital market, you are correct. First reason is the culture. There is a misunderstanding of the benefits for them, so there is a real need to educate them on what it can bring to them. And secondly, there is a fear, again, it's around culture, but there's a fear of losing control. You know, there's a fear that, if I go into under that process, I might lose control of my company. So it takes years because, you know, you need to educate them, you need to assist them so that they, you know, they do understand the benefits to them and they do understand that they can still be involved. And also, yeah, they don't want to, also there's a fear of, you know, giving information about what they do. Again, it's around culture, yeah, financial information to the market. They don't want people, they're very protective of what they do. So there's a real need in our market of education, you know, process for those entrepreneurs.
And Carol, turning to you specifically, given your work really in the development of more sell-side research for your market, any comments that you could give in terms of, particularly within the BRVM, what initiatives you've undertaken or would like to see undertaken to elevate the level of information that is available on capital market players within your region?
Yeah, that's our daily struggle because there is a real, listed companies, not many of them are willing to communicate with the investment community. First issue is in terms of timing when they release their financial result. So the regulator here has been working hard on it last year to review some of the regulation around it to force them to release on time. Unfortunately, we had COVID, so it was another year of delays. And secondly, it's a culture. There are very few companies that are willing to talk to investors, and it's a struggle for us on the sell side to say, listen, I have people interested, but they just need, okay, they hear the story from me, but they want to talk to management, they want to hear from you, and they want to find out about what are your strategy, what are the perspective, and yet another issue also is the information available. True, they do release information, but there is very little. It's just numbers, so it's very hard for people to to see the perspective or the strategies of those companies. So I mean, on our end, we just keep knocking on the doors, we keep asking. With very low success ratio, unfortunately, but we just keep doing it. And then we also escalate to the regulator. I think they heard us, so hopefully we'll see results from that, from those new, they did reinforce a little bit the regulation around, I mean, people are supposed to pay penalties if they don't release their financials on time. So, but like I said, because of COVID, everything has been delayed, so we'll see. We'll see.
Thank you for those insights. Maybe to then bring in Ibukun on this and really the work that you've done, both in twinning agreements with certain stock exchanges, not only in Africa, but in more broadly in emerging markets. And I nearly get the sense that we should be unpacking your brain and taking your learnings, because you've seen a lot of this before. And how should we be trying to accelerate these learnings to more of our African markets?
Yeah, thank you, Gerald. And just before I start, maybe just to comment very quickly on the initiative by FSD Africa and RisCura in terms of doing this report. I think it's a timely and most important thing to do as we move forward. And probably the best way to demonstrate that is if you take a look at PwC's IPO report from 2019, which was the last IPO report that they did. I think one is coming out in March. It showed that about $1.2 billion was raised in 2019 by African companies. And that number was about 0.5% of the global total raised in IPOs, which was just over $200 billion. But Africa is 2% of global GDP, not less than 0.5%. And similar growth rates in 2019 of around about 3.5%, which means that Africa is unable to achieve its actual position in terms of demonstrable growth moving forward, because there is not enough capital going into the companies that are the engines of economic growth for the continent. And this is a serious problem, which is why the report is timely, and it's important that we're finding out why there is market failure in this particular instance. So at London Stock Exchange, we're very committed to this particular problem. And Gerald, you've been part of a group called the London Stock Exchange Africa Advisory Group, which works very closely in collaboration with African stakeholders to look at these challenges and how to address them. And I think the issue, the largest issue that we see is this real issue around the intermediation between sources of capital and the recipients of capital. There is no shortage of capital to come into Africa. If you look at the instances of negative capital or capital with negative yield in and around global investors searching for yield, a lot of that should be transferable into the Africa economic opportunity, which nobody denies exists. And secondly, with local sources of capital, your report, Gerald, has very, very clearly demonstrated that there is a wash of capital across the continent from the asset management community, untapped as yet. So how do we remove that intermediation issue? I think is something that's very, very important. But to your question, Gerald, and one of the things that we've felt is most important to eradicate these issues is transparency of information, is the key core problem that we see in the continent. One of the reasons why LSEG launched this Companies to Inspire Africa publication back in 2006 was to demonstrate to companies themselves that if you are more transparent with information that you provide, you will have people making more informed investment decisions and giving those opportunities an opportunity to develop and grow. And I think the single most issue is that, and we've demonstrated with that publication, where nearly $3.4 billion worth of capital has been raised by about 160 companies within that publication, for those that are not familiar with it. That's a very clear demonstration that if you are prepared to open up, that the benefits that you get from that are very clear and very tangible. I think the last point I want to make is around the cost of raising capital on IPOs, and I think Catherine will agree with this. The cost of raising capital on IPOs is probably not too dissimilar from the cost of raising private equity or venture capital. Yet the longer term benefits in terms of profile, in terms of inclusion in other areas are very significant. Let's take Seplat Petroleum, for example, a Nigerian company that listed in Nigeria and London in 2014. The cost of raising capital for that company has dropped from something like 7.2% right the way down to 3%. They launched a bond offering in 2018 where their coupon was less than 5% as an African issuer. And they also, in terms of secondary market liquidity, because of their inclusion in an Africa index, are able to increase liquidity opportunities for their shareholders, which is absolutely fundamental in terms of encouraging and regenerating new investors over the longer term. So the benefits versus the costs of listing, I think, are unquestionable for those companies that are brave enough to put their head above the parapet.
Fantastic point, Ibukan. Thank you for those insights. And I suppose that kind of gives a good segue to Mary, where you've had the perhaps fortune or misfortune of sitting on both sides of the fence, where on the one hand you have sat as a regulator on the continent and helped in terms of creating a regulatory environment and facilitating a regulatory environment for more companies to list. Then you've now sat on the other side where you're now really at the coalface of enacting those aspirations as a senior capital market specialist at FSD Africa. Perhaps from your perspective, are there any areas that we are missing, particularly with an appreciation of the regulatory environment as it pertains to raising capital in Africa?
Thank you very much, Gerald, and thank you for your excellent study. I think it was very interesting and very interesting insights coming out of that. I found it particularly interesting to see the differences in culture in the different parts of sub-Saharan Africa that you are looking at. And I'm sure that those may also lend themselves to some aspects of the regulatory environment as well. And so I think just picking up on that and some of the points that you made in response to the question is, I think it's important for us to understand, even when we're talking about the enabling environment, the regulatory environment, to understand the genesis of stock markets in sub-Saharan Africa, where they are now and where they aspire to go. I think you made a very important point that stock markets are a creation of privatization efforts of government. And because of that, I think we find that most of the, the companies that are listed there, the large companies that have most activity are some of those entities that were actually privatized at the time. And I think the big question to consider is how to grow these capital markets, or rather the stock market, more holistically. So looking at not just the enabling environment, which of course includes the regulatory environment, some of the issues that have been discussed about data, making data available, there are issues around liquidity, costs as well, and just transparency. When you look at trading, for example, you've talked about the scenario in Francophone West Africa about the different tax treatment for different products. So how does that lend itself to actually encouraging people to come to market? So what I'd say is it's important to have a very holistic view, and I think that's what I've come to appreciate with the work that we do at FSD Africa, because as you made a point, I think towards the end of your presentation, that it is really stock market growth or encouraging IPOs is just one factor of so many other pieces that need to really work well. One is, of course, the enabling environment, which is very important, the regulatory environment, and we've highlighted some of those in the discussions, even from previous discussions. Then on the issuer side, as an issuer, of course, issuers want to come to market because they want to realize value and they want to be able to raise capital. But what does that mean for them in terms of course, there's the issue of cost, but there's also the issue of once an entity is listed, how easy is it for it to continue raising capital on the stock market, for example? Is it easy to do that on an ongoing basis? Do they have to go through rigorous disclosure requirements, for example? Even if they've been listed, what is the value add for them? So I think it's an issue for stock exchanges and the entire market actually to consider what is the value addition and how can that be translated into a facilitative regulatory environment. When you look also on the demand side, you're looking at, we talked about institutional investors, and I think there's a more macro issue there around, we've talked about high interest rate environment in some markets, actually in many markets, that crowds out any other, kind of investment on the private space. So that's an issue that requires policymakers' attention. And I think that's why I'm going back to the point that for any of these interventions, capital market development interventions to have impact, there needs to be a very holistic approach to capital market development, and so not just stock market growth and activity. So in relation to that, developing road plans, implementation roadmaps that are very specific on what needs to be done collaboratively in the market, through, for example, capital market master plans is important in many of these markets to be able to unlock some of these issues, which, as you say, do not lend themselves to the stock exchange itself. Some of them are very structural. So I think that's what I would say on that. Just having a bird's eye view on the entire, on the entire market is useful. Thank you.
Thank you for those input. I'm just going to turn to questions in the Q&A panel. The first one, Catherine, really is for you. It goes as follows. With regards to Egypt, what incentives, if any, are you aware of, are provided to companies, particularly within the private equity portfolios that you may oversee or have participated in, that incentivize them to exit through an IPO, other than culture, of course?
Yeah, so I think there are some tax incentives that have been put in place by the Egyptian government around, reductions in, I think in some, there was a kind of a tax on trading that I think they've waived, particularly for foreign investors. And there's also a reduced dividends tax, I believe, for listed companies, and also some capital gains tax reductions as well. So I think that's one aspect, I think, which was mentioned in the report. I thought was also kind of important in trying to kind of stimulate, liquidity. I mean, I think something that we've all, the report mentioned, that everyone on this panel has mentioned, is obviously a very important aspect, because you need to get that liquidity up in order to kind of see the values going up as well that ascribe to certain businesses. And I think one, that you can look at it from two ways. I mean, in terms of regulation to encourage more local investors to invest is one aspect, but you need more companies to list. And so I think tax incentives is one way to do that.
Great. And then possibly a dual question for Ibukun and our colleagues at Hudson and C. Why are we not seeing more intra-African dual listings or listings of a company in Rwanda choosing to list on Johannesburg Stock Exchange or vice versa? And I think it's a corollary question to this. Is it really a disincentive for a company, or maybe let me reinterpret the question. Often the holy grail is to dual list on the London Stock Exchange and another African stock exchange. Is that in and of itself not a disincentive, in that the liquidity is always going to now migrate to this larger international exchange and away from the domestic African exchange? I don't know, between Ibukan and Hudson, and see who wants to tackle that first.
Hudson, we can start it. Cyril was saying we should probably, the question should be asked the other way: which market do allow to dual list? So in our market, it's not allowed. It's not allowed in our market.
Alors, effectivement, dans notre marché, on ne permet pas, on va dire, des entreprises qui ne sont pas basées dans notre région, dans la zone UEMOA, de se faire lister à la BRVM. Par contre, inversement, une entreprise qui est basée en zone UEMOA peut se faire lister sur d'autres marchés. Ça, c'est totalement permis. Et d'ailleurs, on a quelques cas. On a eu des PME ivoiriennes, notamment et même sénégalaises, qui ont été listées à Paris alors qu'elles n'étaient même pas listées à Abidjan.
So the BRVM does not allow foreign company to be listed here. However, you can have a company from here be listed elsewhere without being listed here. So we have example of company not listed here, but listed elsewhere.
Thanks for that.
Par contre, sur l'avantage éventuellement d'un listing sur Londres et sur la BRVM, c'est clair que pour l'entreprise, ça permet d'avoir de lever, on va dire, des fonds, parce que le niveau de valorisation peut être totalement différent d'un marché à l'autre. Donc ça, c'est un élément fondamental à prendre. Sinon, l'opération ne pourra pas se faire. Le deuxième point, ça donne de la visibilité à l'entreprise. Donc, c'est un avantage. Alors, par contre, sur le marché secondaire, il se peut qu'il y ait un phénomène, on va dire, d'absorption. Vu que les attentes des investisseurs ne sont pas pareilles d'un marché à l'autre, par exemple, si l'entreprise a un rendement, on va dire, du dividende qui est de 2 ou 5%, pour la Côte d'Ivoire, pour la zone UEMOA, ça peut être insuffisant. Donc, le titre ne va pas connaître beaucoup de transactions, de succès. Et si Londres juste estime que cette rentabilité est suffisante, il y aura un phénomène d'absorption. On verra l'ensemble des titres donc, qui vont migrer du marché, on va dire, le plus cher vers le marché le moins cher.
Listing scenario, if you have a company from here listing, let's say on the London Stock Exchange and the BRVM, it might be an advantage for them in terms of visibility, in terms of valuation. But where there will be an issue is, let's say if the company pays dividend of like, I don't know, 2 to 5%, it might be considered a low dividend here on the BRVM, and people might not be interested, and it might be a different story on the other market. So over time, you might see on the secondary market, everything migrated from one to the other.
Thanks for that. Ibukan, that may have stolen a few of your inputs, but yeah, happy for you to add to it.
Yeah, thanks, Gerald. And I think it's a very interesting couple of questions, actually. I think there have been many examples, however, of intra-Africa listings. So I can think of a few just off the top of my head. So, for example, EcoBank, which has multiple listings across West Africa. I think O&O was listed in Nigeria and South Africa at one point. And I think Equity Bank also has several listings across East Africa. So I think those instances do happen. However, I think the reason why perhaps there hasn't been an exacerbation of that is that the concept of listing on multiple exchanges was always a way of tapping into lots of different liquidity pools. And in Africa, you can argue that the size of those additional liquidity pools don't necessarily add additional proportionate value for the cost and the additional requirements. I think there used to be a concept of having a global share, and many of the large global companies would seek a listing in perhaps in New York, in London and Hong Kong. And I think that concept probably of being traded nearly 24 hours a day is really what people have always had in terms of that multiple listing type of opportunity. Notwithstanding, as the free trade area becomes more and more relevant, I think we may see a revisit to the multiple African listing, but probably on a much broader regional scale. So the examples I gave, other than the O&O examples, have been quite concentrated in specific regions, but perhaps we may see more north to south or east to west type listing opportunities moving forward. On the question of liquidity with the international exchanges, I won't talk about just London, because I think the instance for African companies to list abroad is bigger than London. But I think that the question is a good one. Liquidity does tend to take the broadband approach and therefore go to where there's more liquidity opportunity. However, it really depends how you construct the deal. One of the things that we've been very proud about are the relationships that we've built with the local exchanges. So for example, our relationship with the Nigerian Stock Exchange, we have a unique dual listing mechanism and a unique post-trade mechanism, which ensures that we don't have two separate pools of liquidity as you used to have in the old days. What we have is a conduit and a pipe which ensures that there is only one share and one ISIN. So you can never have liquidity gravitating to one place. You have a total liquidity which is right in the middle, somewhere over the Sahara Desert, I presume, if you want to say the physical location halfway. But that ensures that there is no differential in market pricing, and the only thing that will ever create a differential is any form of currency or FX type of effect. But that settlement system has ensured that the mix between transactions volume on NSE and LSE has always remained about 50%. Over the life of Seplat's listing in London now, which is coming on to 7 years. So I think if similar constructs can be developed so that you have this uniqueness in terms of post-trade to streamline cross-border settlement, you can definitely have a mitigation of that issue of migration to one center.
Great, thank you all for those responses. I am mindful of time, so I think what we can do is perhaps to give each of you 30 or so seconds to kind of give closing remarks or closing views, key areas that you'd like to see, perhaps more research or answers that have not been answered now. And then thereafter, I'll hand over to Mary to give closing remarks and thanks. So I'm shutting up now. Ibukin, I think you can start it off.
Oh, okay, fine. Gerald, permission to take, it's not going to be 30 seconds to deliver what I have to say. Maybe I can have a minute and be cheeky. Sure. So I think the main thing here for us and our observations is this issue in Africa around information asymmetry. And what I mean by that is people receiving information before others regarding regulatory announcements. And this is a major issue around confidence within the market. And what we've seen in a study that we've undertaken with academia is that Africa tends to see cumulative abnormal returns happening days after a news announcement has been made. You should have in an efficient market data being completely priced in the day of the announcement. Now, if you have a continuation of that, it removes confidence from the market, the secondary market, which is the important market here, even more than the IPO market. So ways of addressing that can be centralized news dissemination platforms, mandatory requirements for companies to use that, and for that data to be collected to perform better secondary market type analysis for companies. So that would be one of our key recommendations and takeaways from all of your work and the work we've done so far. Thank you.
Thanks, Ibogun. Catherine, can we move over to you?
Yeah, thanks. So look, I think there's so many different aspects, but I do think there's a couple that I think are really important. I mean, one, we did talk a little bit about regulation, and I think it would be, I'm not sure how you do this, but to facilitate kind of maybe more discussions between, the PE investors, listed market investors, both international and domestic, about how we can increase liquidity and also what incentives can be put in place to get more local, domestic investors into investing listed stocks, but also encourage private equity to list more of their assets. And how can we also provide incentives for even businesses that are not necessarily private equity backed? How can we help them to become more quality businesses, to professionalize, so that when they list, they really are quality businesses? I think one of the points was pointed out that sometimes the stock market's been used as a dumping ground for the less attractive businesses, and that's just going to make things that's not going to help, because then those businesses perhaps trade at a big discount after the IPO, and it creates this perception that that they're low quality businesses on the stock market. So I think more conversations about how to list, the types of businesses, the types of sectors, and just more education, especially for international investors. International investors, I think would be able to see a great opportunity here, but they just need to be educated about what that opportunity is. And it's just about more outreach and more education.
Great stuff. Cyril and Carol, you have been at the forefront of education. You probably blew in the face, but happy to get additional thoughts from your perspective.
Yeah, we're just chatting here. I guess you said the word. I think for us, education is key. Cyril was also saying maybe there's work to be done, maybe on a selection process, target specific industry, and then spend time with those to help them understand the benefit for them. Cost is obviously a big issue here, because a lot of those SMEs need to spend a lot of money to meet the criteria, to have the proper documentation and things like that, and transparency within their company. So it's a work in progress for us. I think we have little step, like now in the BRVM, they have this little section that they call Elite, where they ask brokers like us to find companies that we can help. So that's I think that's the key. And then the final thing Cyril was saying was on the exit strategy of PEs companies.
Yes, I think that we invite PE company to consider a joint track. That is to say, they have to manage an IPO and an M&A exit strategy. This is very important for the market and for them, because it is to secure the exit strategy. If they have two choices, they can choose in final. And one thing is that it is a way for them to maximize the revenues of the transaction.
Fantastic. Thank you for that input. And then lastly, over to you, Mary.
Thank you very much, Gerald. So for me, I think this has been a really interesting discussion, and I think something that I've just been thinking about as we are going along is how some of the markets, so there's such different markets, stock markets, I mean, in sub-Saharan Africa. Some are really small, and some who benefit from even cross-border activity, more, enhancing cross-border activity, not only within Africa, but in other markets. So I know that there's Africa Linkages program that is ongoing in that regard, and it would be interesting to see how that works. But I think that still lends itself to the issues we've been discussing about liquidity, and so how to deal with some of these more perennial issues that could still pose a challenge if not addressed. So I go back to the point about trying to look at how to do this market development work holistically, and even to think about things differently, so that yes, there's a place for market, stock market growth and activity, But there are other things that also lend themselves to that growth. For example, a vibrant private equity space that is able to, exit through the stock market if it's working efficiently. And so just looking at all those linkages will be very useful. So I think without much ado, mine is really just to thank you all for joining this session. Thank you very much to Gerald and the RisCura team for undertaking this study. Also to thank the my co-panelists on this particular session. I think it's been a very thought-provoking discussion. I think there is a lot for us to think about, and certainly for us who are still working within the sector in terms of developing the market, there's a lot to do. Thank you to the attendees who have joined us. I just wanted to mention that the executive summary, you can see the link on the slide that has been shared. And the recording for this session will be available on our website in a few hours later today. So thank you very much, and I wish you a good day. Thank you.
Thank you.
Thank you.
Thank you very much.
Thank you all. Bye.
Thank you, everyone.